Welcome to this webinar on underwriting a real estate deal. Underwriting a real estate deal is nothing but the evaluation of a particular deal based on various inputs and then generating a bunch of outputs. These could be anywhere from just the back of the napkin math to a number of pages of output on whether to take this risk based on the risk appetite of a particular company or a person who is looking at the deal. Going through the slides about the presenter, my name is Kiran. I work at Key Prime Realty. We do represent buyers and sellers along with investing in deals ourselves. I do own a 54 unit rental portfolio invested in the Greater Boston area. In terms of the brokerage, we do represent buyers and sellers, investors, and we do a little bit of property management. We did about 550 properties in our transactions with a total transaction volume of about 350 million. You can find all our content on any of these social handles. Do check us out. Moving ahead with the presentation. The underwriting itself is a huge subject. I know there are courses designed around it, including some probably college degrees. So what we cover in this 1 hour session is the evaluation of simple property types like a single family or a condominium or a multifamily with typically about 1 to 20 unit or 1 to 30 unit, something like that. The metrics that we'll be looking at are cap rate, cash on cash, gross rent multiplier, equity multiples, average annual return, internal rate of return, and return on equity. So those are the metrics that we'll go through. Straightforward value add or stabilized properties, not like a ground up development. In addition to that, what we'll be going through is analyzing a deal where you're principally purchasing. It's not like you're doing a joint venture or you're doing a limited partnership with some GPs who are doing a huge deal. How you evaluate the general partners or the operators that are actually giving you the deal to look at. So this is basically you are the principal here who is looking at the property yourself. And what is not covered is, obviously when it comes to real estate, location is the key. We're not going to go through how do we evaluate a location, the demographics, jobs, data, construction activity, population, future potential, all that stuff. Those are all subjects themselves which are reserved for their own presentations. How to source due diligence, financing, evaluating a syndicator, rental operations, asset management, business planning, property management, and optimization of the returns. All these subjects are all really concepts. Either you identify the property or once you acquire the property. This session doesn't cover that. This session is basically you're presented with the deal, how you got it, that's a different story, and how do you evaluate the deal. That's it. And then once you acquire, what you do with it's a separate subject. Complex underwriting models, we're not going to do any debt, multiple equity partners, GPLP syndications, debt structures, first level debt, second level debt. We're not going to go through all that. And then intricacies of any ground up development is not part of this presentation. Okay, so once that is squared, let's go through the next set of slides. Now, in order to arrive at the output metrics, the key data elements that go into the processing are these. I think let us spend a little time here and then we go through each and every metric that comes up afterwards. The inputs are gross income, rents. Obviously that is the most important aspect of the gross income when you are dealing with a rental real estate. And then you have some auxiliary incomes like laundry, amenity fees, pet fees, parking, vending machines, etc. And then when it comes to the income, I think there are a few other factors that you need to consider. What is the physical occupancy of the property? What is the economic occupancy of the property? Physically is nothing but vacancies, and economic is where you have a tenant but they're not paying. And also, you need to evict them. And a lot of times you lose a lot of rent during the eviction process. And then concessions that you give, maybe you have a property manager who lives on site, or you have some police fire people who live on the premises, and then you decide to give some concession to some of these essential workers in the society, which is a good thing. Employee discount, in addition to the concessions that you give, maybe one of your employees might be living there at a discounted rent. Then equity debt structure, first lien debt is what we'll be going through. Mezzanine or second lien, if any, that also goes into the calculations. And then capex borrowing and bridge loans. So this is typically when you're doing a bigger rehabs, you're looking at, you raise some capital, you use your capital for the down payment, but once you acquire the property, you need some additional capital to do some of the repositioning of the property, rehabbing the property. So that's where you deal with the mezzanine debt or some of the bridge loans. Rents for underwriting, comes from similar, obviously. So you have the existing rental income of the property. Sometimes you need to do some of these pro forma calculations. So what would be the potential of this property? So a lot of times properties are run under their capacity. So the whole point of these value add type of deals is to bump the rents. And then in order to bump the rents, you got to look at the market. Okay, so what does the market bear? Are we close to the market rent? Are we below the market? Or rarely are we above the market? Comes from similar properties. And then obviously there are some of the resources that I've listed here: Zillow, Zumper, Rent.com, RealPage. There are a few sources where you could source this rent information. And then on the offer side itself, the typical offer is going to be offering memorandum. So that's typical with the small to medium scale multifamilies. But in many cases, you might be just getting one single paper from your MLS saying, okay, so this is the property. A lot of times, you don't get a whole lot of information. This is where you probably need some expertise on analyzing the property. Then unit mix, how many 1 bedrooms, 2 bedrooms, studios, things like that. And rent roll, that is usually given as part of the gross income, but the rent roll is sometimes generated out of a property management software. But if it is run by a mom and pop type of a shop, they may be having it on probably a notebook or a simple spreadsheet. And then profit and P&L statement, profit and loss statement. This is typical when the complex is well managed, but many times again you may not get information properly. And then T12, T6, T3, the trailing 12 months, trailing 6 months, trailing 3 month income and expenses. And then current cap, market cap, pro forma cap. So these are some of the key elements where this is typically presented in the offering memorandum. If it is listed by a professional, they usually list you what is the current cap for the market in that asset type. And then what is the pro forma cap, what could be the cap of this, okay, and then what is the current cap of this property that it is producing. And then capital expenditure that you need to assess. Say if the parking lot is fully done, it's fully depreciated, so you might factor in some amount for capex. Similarly, roof, there are some big ticket items like that which you really need to factor into your math. And then expenses, there's a whole lot of list. I think there are 40, 50, 60, up to 100 elements in expenses. But some of the main ones that actually make or break the deals are property tax, insurance, property management, utilities, repairs, maintenance, asset management, administration, payroll, marketing. Each of these is self-explanatory. If it does make sense to you, I think, we can discuss later. Okay. So these are the input metrics. And then there is processing of these input metrics, and then we extract the output metrics. The output metrics are the ones that you look at. Okay, so you have a desired this output metric, and then you look at, okay, so is it meeting my desired output metric or not, and then based on that you make a decision. The output metrics, like we just briefly gone through the previous slides, we'll go through each one of them in the subsequent slides. So the first metric is gross rent multiplier. Okay, so this is a pretty straightforward metric. All it does is you have the yearly gross rent, and then based on this yearly gross rent, what is your purchase price, and then you just get a multiple. So that's a simple crude math. Okay, and this is sometimes is useful. I don't want to discount any of these metrics because you really want to look at various metrics before you make a decision, because each metric answers different questions. I know there could be some favorites that you always look at. Okay, maybe in my case I look at the internal rate of return, which is the favorite, but that doesn't mean that we need to discount the other metrics. So you want to look at each and every metric. So gross rent multiplier, this is typical. If you want to compare some of the premium areas to some of the not so premium areas, Toledo, Ohio has a GRM of 6, whereas Honolulu has GRM of 14.42. But if you're from a country like India, some of the cities there, I'm yet to see a city where the GRM is less than 14.42. That's how the mismatch between the prices and the rents are. The rents are so low and the prices are so high. But if you have a exactly similar property side by side, so GRM is a simple question that answers you, okay, the expenses are similar on these two properties, but why the multiple on this one is so high when compared to the other one? So it's a crude metric. I can just do it pretty quickly and then come up with something. Okay, so that's GRM. One metric is done, and then we'll move to the subsequent ones. Next one is equity multiple. Equity multiple is a return metric that is typically given to the investor. Okay, so you put $100,000 into the deal, and then maybe after 5 years, okay, how much your equity will be multiplied. Okay, so that's essentially includes everything. You include your cash distributions yearly or monthly or quarterly, whatever the distributions are done. And at the end of the deal, the 5 year that I mentioned is the hold period. So typically the asset life cycle is you acquire the asset, stabilize the asset. If it is good, you keep it forever, or you want to cash in, you could either refinance it or you could just sell it and then make a lump sum profit and then move on to the next asset. So if you have a hold period of say 5 years and then your initial equity of 75,000 has become sale proceeds of 125,000, so you have a total return of total cash flow of 4,800 per year, and then 5 years your total is going to be 24,000, and then sale proceeds is 125. That means you made a nice profit of, okay, I'm sorry, sale proceeds, this is the net after you pay off your debt and everything. So we are saying 125,000 is the sale proceeds, and then total cash flow is 24,000 for the 5 years. So that becomes a total return of 149,000. So that is an equity multiple of 1.9. Yeah, it's a close to 2. That means within 5 years, your investment has doubled. So that's a good way to look at it. Is, I don't know, if you want to compare different investment vehicles, which investment vehicle will give you this kind of return, 2x multiple in 5 years, right? Not so many. So that means this deal does make sense. Okay. So that's equity multiple. It answers concise metric on how much an investor can see their investment grow over a whole period. So this is, I don't know, if you're really borrowing or if you're looking for a partner, this is a good way to present. Hey, if you've put this much 75k now, after 5 years your 75 will become 150. So that's a good way to present this deal. So if you have a layman with a lot of cash, there's a good way to present. So that's, of course you don't find a layman who is cash rich, who doesn't know, I don't know, who is not so good at math and who is only looking at this metric and then just give you a boatload of cash. So typically, they might be interested in subsequent metrics. So let's move ahead with the other metrics, equity multiple. After this, the next one is the cap rate, most widely used throughout the industry. It's a standard for every asset type and the class. When we say asset class, it is the multifamily or we have office. Within the commercial real estate, you have various asset classes. The cap rate is tracked in each of these asset classes, and also within the asset class, you have different types of classes. It's A, B, C. So if you have a say multifamily class A, this is the cap rate that's going. 5 is the cap for the given market. So typically the way you hear about cap rates is, okay, in the metro, Greater Boston Metro, Providence Metro, the class A multifamily is trading at 4 cap. So that's how you typically hear. So that means that is where I think we look at the simple calculations on the cap rates. The cap rate is nothing but the yearly net operating income, and that is divided by the purchase price. Or in case of using market value, cap rate is yearly net operating income divided by market value of the property. Okay, so this is when you are purchasing the property. This is when you are in the middle of the asset ownership. You want to always look at, okay, what is my market value of the property and how much cap I am executing this project at. Yearly net operating income is nothing but you have your gross income and then you take out all your expenses. That becomes your yearly net operating income, and then you divide it by the purchase price. That gives you the cap. So here in this example, this pitch deck these slides will all be given to you after the presentation. So you'll have all this data. So if I'm really going through this fast, you might be able to get back to this and then look at the presentation as well as the slides to understand. So just to see how the cap rate of 6 is arrived in this example, we have rent plus other income 2100, expenses total 600. That's a net operating income of 18,000 for the whole year. And then the purchase price is say 300,000 and the cap rate is 6. So what you notice here is the cap doesn't include your debt. Okay, so that's why usually the cap rates and the debt go hand in hand, although cap is not included in cap rate, doesn't include the debt into the equation. But usually if the interest rates are higher, the cap rates are higher. That's a whole risk-free return concept, right? Say if the interest rates are higher and you can lend your money to a bank or a treasury note or any high-rated corporate bond at say 5% interest rate, and then your cap has to beat that by a good margin, because real estate investment is a risk and also it's intensive. You have to work hard for the returns here, whereas you just buy a treasury, which is the most secured asset, and then after your period you just collect your return. So for that reason, if the interest rates are high, the cap rates are higher, and the interest rates are low, the cap rates are lower. Although lately the whole relationship between the cap rates and the interest rates are out of whack. So even though the interest rates have gone up so much, cap rates haven't gone up by so much. So there are other factors too, obviously. So people predict the future interest rates. People think the interest rates will go down in the future. So that's one reason why maybe the cap rates are not going up as much as one would hope if the interest rates are going up. And also there are demand and supply. That's the other reason too. People want real assets because of the inflation. People think your money or your real estate appreciates better than your money. So obviously that's a whole other equation. So interest rates doesn't mean that you're getting a whole lot of return. If there is an inflation which is eating into your interest, you don't get a whole lot of return on it. So you always need to look at your net interest rate. So if the inflation is 3% and your interest rate is 5%, so your net is only 2%. Whereas maybe people might be thinking my real estate is going to grow better than the inflation. So that's why people might be still keeping the cap rates lower and then buying properties at higher prices despite the higher interest rate environment. So that's the cap. It's an industry standard, good for comparisons. The only downside with this is cap rates. This is slightly, I know it's based on the surveys, there's no math to it. So if you are evaluating property which is coming out to be a 5 cap and the market is 6 cap, it's really, if it's a small market and also the asset is not positioned properly, so there could be some times where you got to use a lot of judgment. This is not an exact science. So that's about the cap rate, and then let's move to the next metric. We have some cap rate additional slides here. So what this slide shows you is the topic that I was discussing in the earlier slide. This is the 10-year treasury, the thick blue chart, and then the triple B corporate yield. So that is the bond. Triple B is relatively a safer one. Of course, 10-year treasury is the safest. So that's why the more safety you go for, the less return on investment that you get. So your 10-year treasuries are here, and then your triple B corporate yields are higher, and then your real estate cap rate is supposed to be higher. So this all makes sense here. Of course, these were really good periods where real estate was cheap. It was trading really at a really nice spreads here, nice margins here. But you look at off late, so this doesn't make sense at all. If the triple B corporate yield and the real estate cap rates are so close to one another, that means this is, by the way, this is all commercial real estate. If you look at the multifamily, actually you might be surprised, the return on the cap rates on the multifamily are lower than the triple B corporate bonds. So that's how crazy the multifamily has gotten to, the valuations. Okay, and then these are some of the cap rates for some markets, are some of the evaluations that people have done off late. So I think 2019 to 2023, if you look, so unlevered IRR, okay, these are some of the written metrics that people have used to come up with the valuations. Yeah, you can just check it out. I think so everybody is banking on this. I think going in cap rate and exit cap rate. I think so people are using still back in 2019 and 2021, 22, and the interest rates were so low, the cap rates were low, and now the cap rates are outrageous, but still the cap rates are still so competitive. So this is what I was mentioning. Despite the interest rate environment has changed quite drastic, the cap rates haven't, at least in the multifamily area. Office and other segments is a total other story, but multifamily is still very strong. Okay, let's move to the next metric. Debt service coverage ratio, this is an important one. I think unless you are purchasing your real estate deal with all cash, your own cash, you're not leveraging any money, this metric probably doesn't matter to you. But yeah, most operators tend to go for debt. So debt service coverage ratio is an important metric. You got to evaluate this deal. Okay, after all the expenses are done, okay, you come up with your net operating income, the way you do come up with in the cap rate calculations too. So with your net operating income, your debt service, so this is the important aspect. So this is directly correlated to your interest rate, and also your IO periods, that is interest only periods, and also your different loan structures. So if you have your net operating income and then debt service, and if it is less than a certain number, the lenders will not look at this deal, and then they say that, okay, we're not going to take this risk. So typically many lenders want this at 1.25, and I haven't come across a lender who can give you at less than 1.15. Is the lowest that you can go. That means after all your debt service is paid, you need to have some buffer in your net operating income. Otherwise, the deal is not going to make sense, at least to the lender. Even as an investor, you should be very careful. Unless there is a huge upside, you are starting with a very poorly run property, and then you are expecting a whole lot of extra income that will be generated down the line. Or you are looking at the interest rates going down, which is a gamble, by the way. Interest rates going down, and then you'll be able to refinance your debt at a much lower rate. So there are few scenarios where you could assume the risk, but otherwise debt service coverage ratio of very low number doesn't make sense. And this is also helpful if you are going after some distressed properties. So during the 2020 COVID peak, this is one thing that I was doing. Look at, actually, DSCR is published by the lenders through some of the software sites. I think CoStar actually tracks this. So if you look at in a distressed situation, say there is a time when people are losing jobs and they're not paying rents on time. So there could be some operators who are really, really struggling. So this is a number that will tell you exactly the story. If the debt service and net operating income, then NOA doesn't even cover your debt service, that means, unless people put money from their pocket, they can run the property. So those are the distressed properties. So this is a nice metric if you are really going after some distressed properties to actually track. Okay. Then cash on cash return, I think this is a nice metric if you want to live off of cash flow, right? So there are investments where you just put the money, you have other W2, other incomes coming in, and you don't care whether you're making money on that. But there could be investors where they just want to live off of cash flow. So they just want to purchase, 100, 200, 300 units and then make 20, 30K per month and then live off of that cash flow. So for them, this is an important metric. Okay. So that's why. So each metric answers different questions. So you cannot discount any metric. At the same time, you don't want to just rely on just one solo metric and then just go with it. So usually, you want to look at these metrics from your individual point of view. So yeah, the cash on cash is nothing but the annual cash pre-tax and then total cash invested in the property. So a simple math is you put $75,000 in the deal, and then you're getting 4,800 as cash. So that's cash on cash of 6.4. So yeah, obviously this cash on cash is not a good metric because various things can skew this deal. So if you put more money into the deal, if you raise a lot of capital into the deal, then yeah, you don't have initial equity is high and then your cash flow is low, then your cash on cash will be differently calculated. On the other hand, if you are giving the cash immediately out without improving the property, then also it can be skewed. So there are so many ways this can be skewed. So for that reason, I think cash on cash, you got to look at it in conjunction with others. Cash on cash alone is never a good metric that give you the total picture. Okay. And the next one is the average annual return. Yeah, this is a good one. So the average annual return is nothing but, see, for instance, if you go back to the previous one, the cash on cash doesn't look at the final event, right? Say your hold period is 5 years, and then after 5 years, you've improved the property, you've improved the net operating income, and then you're maybe, yeah, by luck, the cap rates have gone down. As a result, you're selling the asset at a huge margin or huge higher price than what you bought it for. So you have a huge at the end cash that is coming in, but this cash on cash only, it looks into your annual distributions or whatever is the distribution cycle for this property. But the average annual return is a metric that does, okay, year 1, year 2, year 3, say this is a 3-year hold period, you have a say 10% each year, so that's your average annual return of 10%. So this includes the ROI at the end of the deal also. Say if at the year 3 you're maybe selling the property and then you booked a huge profit. So in that case, this one is going to, the return is at the end. So it is average though. So although you're getting the return at the end, but the average annual return doesn't tell you the full story, whether you receive this money at the beginning of the deal or at the end of the deal. A 3-year hold period is okay. Say if you're holding a property for 10 years, money that you made at the 10th year is totally valued at a different way than what you make at the beginning of the deal. So this is very important. Also, many times people might be promising huge returns down the line, but in the beginning there's not much in the deal. And average annual return doesn't actually distinguish where the distribution is made. This one doesn't include the time value for the money, which in an environment like this where the interest rates are so high, yeah, that's not a, yeah, you want to assign some value to the time. Okay. So average annual return, it's an easier calculation, it's easy to understand, and also it's a decent return metric to look at. Okay. It's also similar to the equity multiple, where say you're making 2x after 5 years, kind of an example, right? So similarly, the average annual return also, I think it gives you, based on the whole period, how much you're making per year. Okay, so this includes all the equity that you've been accruing onto the property, whereas the cash on cash doesn't include all those. Okay, so that's average annual return. Now the next one is IRR. I think this is the internal rate of return. It's slightly complicated to understand, so that's why we'll spend a little more time on this so that the concept is clear. So the IRR takes into account the simple versus compounding factor. Okay, so the compounding is a very important concept, right? So the money earned now, if it is reinvested, so that's the key. If you reinvest the money, that means you can compound your returns. So you get some money and then you reinvest it, and the rate at which you reinvest, it is assumed that you are reinvesting at the same rate of return. In reality, whether that happens, yeah, that's a different story. Who knows? That might be even more. But the internal rate of return actually assumes that you're getting distributions and also you're reinvesting the distribution at the same rate of return. And that's how your internal rate of return, based on the time the return is issued, Yeah, it depends actually. The deal can be accurately compared if you use the internal rate of return than the average annual return, because a deal that returns the exact same amount of money but at different intervals, the IRR differs quite significantly when compared to the average annual return. Okay, so that's simple versus compounding. There are a few slides here. So for instance, to turn $100 into 161 in 5 years, we must compound at 10%. So if you think it at IRR 10%, you might think, oh, it's a 10%. If it is an average annual return of 10%, that would, your $100 would only become 150, right? So you put in $100 and at 5 years you get $150. That's not an internal rate of return of 10%. But the average annual rate is 10, but the IRR will be less than 10. That's because the interval at which you are distributing, I don't think you will be getting all that in the beginning itself, right? So that's why in order to make an IRR of 10, I think your $100 has to be, in 5 years it will become $161. Okay, so that's the power of compounding. Instead of 150, it is $11 more. So this chart actually helps it to visualize. So yeah, you put 100k, and then every year you make 10k, 10k, 10k. That means you make 150k at the end. But whereas you exactly make 10k every year, but if you reinvest that, say in this case, it doesn't assume that it's reinvested. You just take the money and then just, I don't know, keep it aside. But here, if you reinvest it, okay, you make 10, this 10 gets reinvested. So instead of 5 years, I think this 100k, you get return for 5 years, but this 10k, you get return for 4 years, and then this, you get a return for 3 years, like that. So whatever you make, so it gets compounded, and then your money becomes 161, okay, at an internal rate of return of 10%. Okay, so that is the power of compounding. So the math to calculate IRR, I think if you want to do it yourself, it's very complicated, but the Excel has a really nice formula to do this, which I will show you how to do this in Excel. Okay, so the internal rate of return. Okay, so these are coming from the Excel spreadsheet. Actually, I will be sending you the Excel spreadsheet also for this. So yeah, this is an asset which is purchased at $1 million, and then closing costs are 10,000. And then we are taking hold period as 5 years, and then exit. After 5 years, we are exiting the sale at exact same 1 million only. Just for the sake of this, it's a very bad deal if you're exiting after 5 years at the same price as you bought it. But although it's good to assume these kind of conservative assumptions, you never underwrite the deal based on the prediction that you'll get a huge appreciation at the end of the deal. That is never a good way of underwriting. Usually when we underwrite, we always look at, okay, this is the purchase price, and after 5 years, 10 years, 15 years, we are going to sell it at $1 million, or if not at $1 million, we are going to sell it at not this way, but you want to look at cap rates. So if you're acquiring the property at 5 cap, you always assume that your exit cap is higher than your entering cap. That's very, very important. Okay, so that way, if the prices do not appreciate, so that is the market appreciation. But what you do force appreciation is a totally different story. You might be improving the net operating income by a great margin. As a result, $1 million asset can be sold at much higher. Say if the $1 million, if the same NOI is there from year 1 until your whole period end, then you shouldn't assume that you're selling it at $1 million. It should be actually less than $1 million. Okay, in this case, we just assume that we're selling it at $1 million, and then sale cost is 50. Usually you pay commissions at the sale. That's why the closing costs are a bit higher at the time of selling. So here, the acquisition, year 1, year 2, year 3, year 4, year 5 scenarios. So we have the purchase price, closing costs. So this is the money that we are putting up front. So that's the key. Okay, I think the financing is taken out of the equation so that the math is a bit simple. So the million and 10,000, so that is our net cash flow. So that's a negative, right? So we are just putting into the deal $1 million and 10,000. Okay, so the present value factor, so this is the important thing. So the present value factor is based on the discount rate. It's called cost of capital. Yeah, you could call it whatever. I think the interest rate at which you're borrowing, or the interest rate at which your money could make. Okay, so that is the discount rate, it's called. So it's 100% now. At 6% discount, the same 100 will become 94. It's $6 less. If you have $100 now, the same $100 is at a discount rate of 6% or the cost of money at 6% or an inflation of 6%, it's only worth $94. It cannot go that far. Okay, so this is what it tells actually. So you have the 6% is reduced your discount rate reduces the value of money by 6 every year. And then the present value is, this is what I think we have, 1,010,000, and then year one, say we made net cash flow. Okay, so year one there is a net cash flow of 80,000. We're saying year two we have a net cash flow of 100, and then year 300, year 400, and year 5 we disposed the property and we made a whole lot of money on it. Okay, so this gives us, okay, so the 80,000 that we get here, okay, so the 80,000, say it gets reinvested, right? So if you're looking at this at this time, okay, so there is a discount value. So your 80,000 that you received at the end of year one has lower value now, right? The present value of 80,000 at the end of year one is only 75,200. So you want to multiply it with your present value factor. Okay, so that's how you come up with the present value. So the net present value of total return is 104,700. Although you made more than what, so you made more than what this is, but the NPV is what that tells you. Okay, the NPV is what tells you at the current value of this money that you are making, how much is that is worth. So that is how you come up with the NPV. IRR is a formula where the NPV will become based on your discount rate. The NPV becomes 0. So that's the formula. But I think if you look into the Excel, I think that gives you the exact formula to calculate the internal rate of return. Okay, so if you look here, the internal rate of return changes based on how your distributions are. Okay, so for instance, this is the math when you're doing the distributions yearly, right? The same distribution, if it is done quarterly, see year one it is 80,000, right? So you have, instead of doing 1 year and distribution, say we're doing 4 distributions. So then, so you have money coming sooner, then the internal rate of return increases. So instead of the same amount of money that you receive but at a more regular intervals, your IRR increases. So this is essentially the value or the significance of internal rate of return, the time value for money. So money earned in the beginning is not the same as money earned at the end. Money earned at the beginning can be reinvested. It has much better or more value than what you earn at the end. The spreadsheet has, let me see if I can quickly go through the spreadsheet with you so that okay. So this is the NPV versus calculations. So this is actually, you could play with this. You could just work out your distributions and then you should be able to work with it. So the purchase is this, and then so you can just play with the distributions. The net operating income as, say, instead of 80k, you make 100k, and then so the formula is really simple. Good thing is it's all XIRR. Yeah, IRR is if you have regular distributions or uniform distributions, you use. But here the distributions are not regular, they are irregular. So that's why we're using the XIRR Excel formula. So all you have to do is you just look at your time periods and then you key in your cash flows, and then the Excel will give you the IRR. Same here. So this IRR is more because of the same amount is being distributed, but it is distributed at quarterly distributions. Okay, so we are getting quarterly returns, the exact same amount, so the IRR is a bit more. And then if you do monthly distributions, you can see bigger IRR. And also the IRR goes down if you do a lump sum distribution at the end, but you don't do any distributions in the beginning of the deal period. So this is a very good way of looking at or comparing deals apples to apples, right? Say if you're getting on your 100,000, your equity multiple is 2 on both the deals, but if you are in a dilemma where to invest, the IRR will give you the better answer. Okay, you're getting your equity twice in 5 years in both the deals, but one person says that they will give it a big chunk of it at the end of the deal, and the other deal is doing a more uniform distributions. That means the rate of return is better in the latter case, because you get the money up front, which you can reinvest, right? You could put it in markets, you can make more money on it. Okay, or even if the operator puts the money in the same deal and then improve it, that also can actually amplify the results. Okay, so that's on the IRR calculations. I'll be sending this spreadsheet, I think, which you could use it. Then let's go through the other content on this. So this is the internal rate of return continued. So the IRR, the good is best of all metrics. It's a good, it's a relatively much better metric to use because it includes most of the details, right? Except the borrowing. So you have everything. You have your net operating income, you have your cash flows, and also you have the time value for the money. So includes the time value, time of return realization, reinvestment is included in measure. Same IRR could have different IRRs. Okay, so that's the not so good is the reinvestment is an assumption, obviously. So that's if you're investing in a great deal, you might rather have that reinvested in the same deal to get that return amplified or compounded rather than take out the money and then put it in a savings account. So that's the reinvestment is an assumption, but the reinvestment could be lower or in some cases higher too. Sometimes reinvestment into the asset could produce more income. Complex needs a tool to calculate. This is tough to understand, right? If you think about it, I think average annual is rest of the metrics are all simple. This one, I think, if you do a calculator and try to do it yourself, I think it's quite complicated. So that's why we do this using the Excel. So that gives rise to our last metric, which is the return on equity. So this is one thing that I know many of you who are watching this, you're all property holders, right? So I keep hearing the term like, I've purchased it at a very low price, so I'm making a lot of return on this investment that I made maybe 10 years ago. I bought it really cheap. But I think when you're sitting on an asset, you should always look at your return on equity rather than a return on investment. So your basis on the deal might have been way low, but it might have appreciated quite a bit. I think if you purchased 10-15 years ago, I think the assets have appreciated quite a bit. So you're sitting on a whole lot of equity. So you got to always think, how can I use the equity to make return, right? You could refinance the property, or you really want to work with your equity. So what this tells is, with your equity, what is your return? So that's why you should always keep revising your formula. Okay, your asset at the time of acquisition, you're getting these metrics, and year 1, what are your metrics? Year 2, what are your metrics? For your equity, if your return is not so good, I think you probably want to play with your equity. Pull the equity, reinvest, or sell it off if the prices are really good. If you're not, that means you're not operating it well. So if you're operating it to its fullest potential, then cash out, refi. Okay, you just refinance and then take the cash out and then reinvest. So essentially, that's one thing. I think this is one important metric that people lose sight of. I bought it at a very cheap price, so I'm making a great return on this investment. But I think you need to realize your equity too. Okay, so that's one thing that you want to keep an eye on. So I think now we'll move to the live underwriting of a deal. So this is the second part of the presentation. This again, this spreadsheet will be distributing to each and everybody who has registered for this webinar. Let's get to the live underwriting of a sample deal. The live underwriting of a sample deal, we're not doing any IRR calculations here because there is no hold period. This is how I typically acquire properties. I do not have a hold period. If I am bringing on other investors, maybe they have needs, but my intent as of now is buy and hold in the distant future. That's why I did not have a hold period and average annual return calculation or internal rate of return calculation, but I'll show you how I factor in the equity that I am putting into the property in my monthly mortgage payments, so that I know exactly how much I am really making on the deal rather than just the cash on cash return. Okay, so this is a simple deal, say, I don't know, just 70 Broadway, unit 31, let's say that. And then let's say the acquisition of the property is, it's as of closing. So say February 1st, it will be closing. It's built 1983. There are some of the characteristics. This is used to find out the comparable prices and rents. Here, I think I missed this point, the depreciation period and the tax rate. I think this is two important factors, right? So you purchase real estate or you invest in real estate for depreciation too. So that's one important aspect of the benefits of investing in real estate, right? So you can do write-offs, right? An asset is 100% depreciated in 27.5 years. You believe it or not. Although we look at the appreciation, but in the view of the IRS, the assets depreciate. So if you say purchased a property at 275K, then you can depreciate 10,000 every year. So that's an amazing power of depreciation. So if you have a $10,000 income from this asset, you could fully depreciate it, by the way. So that means you don't need to pay any taxes on that $10,000 for that year. The depreciation is really a deferral, okay? And there are strategies to defer it forever until a person gives it away to their children, like until they decease, right? So that's the power of depreciation. So you can defer the taxes even if you don't hold on to this asset. There's this concept called 1031 exchange. That's a different subject altogether. I think you might want to explore that on your own, or I'll set up another webinar for that. You can 1031 into assets, and then you keep on accumulating assets without recapturing depreciation in your lifetime. So that's an amazing concept, the 1031 exchange. So anyways, so you, by the way, when you defer the depreciated amount, see, the tax that you save is on your regular income tax. This is an important distinction that you should take care of. Say if you are a high income individual who is paying 40% income tax, so your 10,000 net on this property is taxed at 40%. But if you, because of the depreciation, you do not pay that 40% on this. But when you dispose this asset, say if you're not doing a 1031 or you're not really deferring it forever until you die, the rate at which you pay the gains is, I think there is a 20 or 25% gains tax. So you're not going to do a 40% income tax rate. So if your capital gains tax is less than your income tax, that's a sure shot saving in terms of the taxes. Okay, but anyway, that's a different concept. That's your accountant, your individual situations related. I don't want to make any representations and put anything in your mind that is not accurate for your situation. So you need to work with your accountant on that, tax professional. So going through this, the asset is 340K. This is a condo unit. In condo units, you can depreciate 340K. In case of single family or multis, you got to take out the land, because land never depreciates. You have to depreciate only based on the building. Now we are just having a few items here. I'll just need to go through it quickly. So 340K, we are acquiring the property. Total asking is 340K, and then unit price renovate is 3,000. 343 is the total basis. Usually we should put some closing costs also. 25% is down. That's typical for investment properties. If you're looking for lower down payments, you might be looking at less favorable loan options. So you're putting 88K. So this amount is important because your cash on cash totally depends on how much you're putting down and how much you're using for renovations and all. Rent unit per month 2600, and then this is total rent. And then this math actually gets to you using common sense. That's why I'll just brush through it really quickly. So the rent, obviously there are a few things that go into the calculations here. So what is your total rent? What is your occupancy? This occupancy could be physical vacancy or economic vacancy or any discounts that you give to, or you could be giving a discount to a good tenant too. So there, based on all this, I think the national occupancy itself is quite high in the 95s. Greater Boston is more than that, so I just put 98% as the occupancy. So based on the occupancy, I think your net is slightly lower than your yearly. So instead of 31,200, it's 35,76. Then this is your monthly, and then so these are the things that you need to. In case of a condo, I think a lot of it is expensed as the condo fees, right? The maintenance is taken care by the condo association, and then the annual fees are 3,000 times 12 on the condo fees. Tax per year, and then insurance per year. Since most condos have master insurance covered in the condo fee, the insurance is just for the unit. It's about 400, 500 for this per year. And then tax per month, and then insurance per month, and then a loan principal. Term, we are using 30. You could just play with it. You could just do it for 25 years term or 15-year term. I acquired early on properties using 15-year terms and then still cash flowed. Now it's very rare or close to impossible to cash flow with a 15-year term. Total months is 360, and then interest rate, I think you got to play with it. I think there is 5.75 is possible now, but I think 6.57 has been going on for the last 1-2 years, but 5.75 is possible now, particularly if you pay, I think, 3/4 a point or something like that. 5.7. Recently my buyer borrowed at 5.75. And then loan pay is this much, and then cash flow. So this gives you the cash flow. So at this rate, you make $460 on your. So what is this cash flow on? This cash flow is on your initial investment of 88 plus the renovation cost of 3. So your 91K produces you 460 per month. You got to look at this. So this is the cap rate. Cap rate is nothing but your net operating income divided by purchase price. That's 6.82, which is a good cap for this market. I would say. Because if you put your money to work, I think your net is going to be based on inflation. I think if you put, say, the 10-year treasury is at 4. So if you buy a guaranteed coupon of 4% for a 10-year treasury now, but your inflation probably anywhere at 2 to 3%. So your net is just 1%. Whereas the asset hopefully appreciates with inflation. So your 6.82 hopefully is going to be a much better return. But obviously, this return is with a risk. So you are assuming this property and then managing the property, finding the tenants, managing the tenant. So with all this risk, obviously, you're getting a higher rate of return. Okay. Cash on cash is 6.25, which is pretty good. So this would be, if you include the tax equations and all, it's much better return. Because if you put this in a CD or something, you get if you put it in a money market, that's even better. But I don't know, most people I know just leave it in the savings, earning 0.2% interest or something. So obviously when compared to that, this cash on cash is way better. Even if now I think you're getting 5% on money market, this is still better than, it beats the money market. And money market obviously goes with federal funds rate, and you never know. I think they're expecting multiple rate cuts this year. So you wouldn't be surprised if the money market will lower it from 5 to 4 and to 3 in no time. Okay, so that's cash on cash. So these are the other numbers. I think I just put some effort into making this spreadsheet. This is my own. I think there might be I'm looking to improve this. But what this gives is my asset hold period is all forever, right? So I look at my rate of return. Okay, how is it after 5 years? How is it after 10 years? How is it after 20 years? How is it after 30 years? So this spreadsheet helps me. Okay, now I'm acquiring it in 2024. Now how will it be returning in 2034, right? But the assumption is that whatever your expenses, you are increasing your expenses with your rents. Okay, so you want to keep an eye on that, because taxes do rise. So, and rents have risen quite well, and they beat your expenses past 3 years. But you want to make sure that your increase in the rent is on par or above the expenses at least. Okay, you want to make sure of that. At least, yeah, you just follow the CPI, consumer price index, and then yeah, you can increase your rents with CPI. I don't think that's a good justification for your rent increases, although based on the market, the rents could be increased much higher. For Greater Boston, at least, I think the supply is so limited, and also there's not much construction activity. I'm thinking you should be able to increase your rents much more than your expenses. So, but anyway, that's an assumption, and you don't want to underwrite based on these kind of assumptions. Okay, these are all best case scenarios. You always assume the conservative situations. Okay, your expenses raise, and with expenses you raise your rent proportionately. So this model just assumes that, nothing more than that. Okay. Then I think, so every cap percentage down pay with equity. So I include the equity. See, when you are doing a monthly payment of 1,222 in this case, 266 goes to the principal, and then 720 the remaining. Okay, this is the interest. Sorry, your monthly payment is 1,488, and then this is fixed for the term of the loan. So in this 1,488, I think you have a loan, the interest component and the principal component. The principal is 266. By the way, this is much lower now, but if you look at your scenario towards the end of the deal, I think, yeah, this is much better. So then your cash on cash or cap or your return on investment actually is much better, right? So 9.9 first month, 9.91 next month, 9.94 next, 9.5 next, 9.97 next. So it keeps on going up because the equity, you keep on building more and more equity as you progress, right? The equity portion of your mortgage payment keeps on going up. And also I put, I think, depreciation, yeah, if you include the tax advantage also, the rate could be higher, but I'm not including it. But yeah, you could really push this number into double digits. But even without the tax advantage, I think you are going into double digits in the first year itself. Then if you go after a few years, I think, yeah, whole period, I think you're looking at 14, 16, I think, yeah, towards the end, I think you might be, I didn't do it at the total 30-year period. Yeah, within 15 years itself, I think you're looking at 15% return. So this is essentially the power of the real estate investing based on the leverage money, right? You borrow the money. You only giving 25% of the money into the deal, and then 75% you're borrowing from the bank. And the good thing is, if you have a low interest rate environment like what we have seen in the past many years, then I think you borrow the money at really cheap, like 3% or even, I don't know, 2.5% and all. And then you use this model and then you build wealth, right? It's long term, by the way. So the wealth accumulates slowly. I know it's not like a Meta stock or a Tesla stock kind of wealth building, which comes with huge risk. But this, I think, it's a moderate risk, but at the same time, I think you can grow your dollars really nice gradually, and at the same time you get some cash flow also, which you could reinvest. So this doesn't assume the reinvestment portion, but all the cash flow that you get here can be reinvested. And then, by the way, a cash on cash of 9.9 on it, this is, I don't believe, I don't know, even if you go to S&P and then try to find a company that gives this much dividend, I doubt whether you can find a company that gives a dividend of this nature. Okay, so that's pretty much it on the underwriting calculations. Yeah, I'll be sending you this spreadsheet. You can just play with it, modify it, distribute it, do whatever you want to do with it, enhance it. Okay, all right. So that's all good. If you enhance it, do send it back to me. Okay, all right. That's really about the underwriting of a deal. And then, so the way I designed this is to put the deal side by side. This is one property. And then before I pulled my first property, I might have analyzed 30 or 40 properties. So this is filled with many numbers before I pulled the plug. It made sense. I know I'm very conservative investor, very low risk taker. So after looking at a number of them, it made sense. Okay, this cannot go wrong. And yeah, I started this in 2014-15. Yeah, I've been very lucky that the market has taken the turn that it has taken. But even otherwise, I think it made sense. It made all the sense because of the way the prices were back then. Now the prices are high, but the rents are high too. So it still makes sense. There are deals to be found even at this time too because of the rents. The rents are strong, so I think it still makes sense to put money into real estate investment. Yeah. Like I think, yeah, I've read somewhere that the Empire State Building owner sometime was saying this. If yeah, this is the beauty of real estate investing. So the bank gives you 75%, and then your tenant pays you to manage the property, pay your mortgage. At the end of every month, put cash in your pocket. I don't know what better investment that you can think of that does this. So it does make sense. So I think, yeah, I hope you see this, and then as long as it makes sense. I know there are some places where it may not make sense. I don't know. We have some neighboring towns. So I think, yeah, if you're from Boston and all, there are some towns where this math doesn't work at all. There's no way you can buy a 1983 built 1880 square feet condo at 340. So if you're buying in, say, Cambridge, Massachusetts, this probably run into $1 million. And then in order to cash flow, so you have to charge probably $10,000-$15,000 rent, which you will not get. The rents will not deviate by so much. So I think you want to look at areas where it makes sense, unless your investment methodology is totally different. I think so. Those are the cities called, say, Cambridge. The cap rate is so low. So when the cap rate is so low, if you can force appreciation, I think, yeah, you purchase one and then make 2 units, or if you purchase one and then you take down the expenses and then you bump the rents. So if you manage to improve your net operating income, you make more money in a low cap city than a high cap city. So if your model is to force appreciation, then I think, yeah, you might be able to go into these premium towns and make money. But if you're like me, who is buying and holding it for many years in a row, then I think this probably makes better sense. Okay, so I think so that's on the model underwriting. Now I think we'll open for questions. Okay, right.